Welcome back to the Deep Dive. Today, we're doing something a little different.
Yeah.
We're taking a snapshot of the economy, but not with stock tickers or, GDP reports. We're looking at something much more tangible. Commercial real estate listings.
Right. Boots on the ground.
Exactly. Specifically, we have a stack of opportunities and market commentary from Eureka Business Group out of Plano, Texas, and it's capturing the market right now in January 2026. And I have to be honest, I was reading through Joseph Goslan's notes on these, and the very first one made me think I was reading a typo.
I have a feeling I know exactly which one you're talking about. It completely disrupts the narrative we've been fed for the last, 4 years?
The bold experiment, as they call it. For years, I mean literally since 2020, but really heating up from 2022 to 2025, the headline has just been the office apocalypse.
Oh, constantly.
We've watched developers just tripping over themselves to convert empty glass office towers into apartments.
That was the solution.
Right, that was the solution. But here, in January 2026, we have a listing on CoStar doing the exact opposite. A 2-story apartment building residential being gutted and converted into office condos.
It just stops you in your tracks.
Yeah.
Forces you to ask, is this developer crazy, or are they seeing something the rest of the market has missed?
And that's our mission for this deep dive. We're not just reading price tags. We need to decode the strategy here. Why turn apartments into offices now? What makes a warehouse mission critical?
And why on earth would a school district sell land with a sealed bid?
Yes, that's the right approach. You have to look at these listings not just as buildings, but as these specific bets on the future.
On behavior, yeah. Bets on how people and the economy will behave. Whether it's a defensive play like a grocery store or something really aggressive like that zoning flip, every single property tells a story about risk and reward.
Okay, let's start with that risk, because I am still stuck on this apartment-to-office conversion. The commentary says this is in a downtown zoning area, so a developer is taking residential units off the market to build offices. My first reaction is just skepticism. With remote work still a massive part of the culture, who's dying these things?
It does seem counterintuitive if you only look at the macro headlines. But real estate is so hyper-local.
True.
You have to peel back the layers. First, look at the product type. They're not building a 50-story corporate headquarters. They're building office condos.
Which means the tenant isn't leasing, they're buying it.
Precisely. And this plays into a microeconomic trend that often gets ignored. So while big corporations are shedding space to save money, you have this huge layer of the economy, independent accountants, lawyers, specialized consultants, therapists who are frankly tired of working from their dining room tables.
I can believe that.
But they don't want to sign a lease where the landlord jacks up their rent 5% every single year. They want to own their dirt. They want equity.
So it's a hedge against inflation for a small business owner. They'd rather pay a mortgage to themselves than rent to a landlord.
Correct. And think about the downtown zoning part. Goslan notes it's flexible. This developer might be looking around the neighborhood and seeing an oversaturation of residential. I mean, if everyone else zagged to apartments.
The supply of small, buyable office space probably dried up completely.
It's a classic contrarian bet. If you buy when there's blood in the streets, or in this case, when everyone hates offices, you might win big because you're the only game in town.
High risk, high reward. If the local CPA needs an office and can't find one, this developer looks like a genius.
And if not, they're stuck with empty shells. But it does signal that the whole office is dead narrative. It might be starting to fracture.
Okay, let's dial down that risk meter a bit. Let's move from the bold experiment to what the industry usually thinks of as a safe harbor. The source material has a whole section on assets under $2 million, specifically medical and office.
Right, this is the bread and butter for a lot of private investors. You're not trying to reinvent the wheel here. You're looking for cash flow.
And the listing in Bedford, Texas stands out immediately. It's a 5,000 square foot medical office building. But the headline isn't the building, it's the tenant, Baylor, Gott, and White.
That's what we call a credit tenant. The creditworthiness of the tenant is almost as important as the real estate itself.
Sometimes more important.
Oh, absolutely. Baylor, Scott & White isn't a mom-and-pop shop. It's a massive healthcare system. The probability of them defaulting on rent is just incredibly low.
But looking at the details here, the lease term remaining is only 3.25 years. If I'm an investor, that makes me a little nervous. 3 years goes by fast. What if they leave?
And you should always be cautious about lease term, but medical is unique. We call it sticky tenancy.
Sticky.
Yeah.
Yeah.
Think about the physical reality of a medical office. They have lead-lined walls for x-ray machines, specialized plumbing in every exam room, heavy electrical loads for all the equipment.
It's not just desks and laptops.
Exactly. The cost for Baylor to just move that clinic down the street is astronomical. It's disruptive to patients who all know the location, and the build-out costs for a new space are huge. So when you see that they have 3 5-year renewal options,
The chances of them actually using those options are way higher than for, say, a law firm that could just pack up over a weekend.
the switching costs are golden handcuffs. That's the idea.
That makes sense. There's another note here about a new roof in 2025 and HVAC replaced.
And that's critical for your return, especially in this price range. If you buy a $2 million asset and 6 months later you get hit with a $50,000 roof bill.
That just kills your yield for the year, maybe 2 years.
It does. Seeing those big capital expenditure items already handled means your cash flow is actually cash, not just a rainy day fund you have to hoard for repairs.
Okay, let's look at the next one in this category because the strategy shifts from credit tenant to creative financing. We've got a listing in McKinney, Texas, about 2,900 square feet. The notes say owner financing available and below county assessed value.
That combination screams motivated seller.
But tell me about the owner financing part. Is that just for buyers who have bad credit and can't get a bank loan?
That's the common misconception. I mean, sure, it helps if you're not bankable, but in a market where interest rates are, volatile or banks are tightening up,
Right.
owner financing is a strategic tool for speed. A bank can take 60, 90 days to close. They want appraisals, environmental studies, endless paperwork.
And an owner might just say, look, give me a down payment and I'll be the bank.
Exactly. It allows for creativity. Maybe you negotiate an interest-only period for the first year to boost your cash flow. It opens the buyer pool up to entrepreneurs who have strong cash flow, but maybe their tax returns are complicated and confuse a traditional underwriter. It's all about getting the deal done. Then we have this tiny unit in Plano. Only 756 square feet.
Tiny.
It's in a prime West Plano location near Willow Bend. My first thought is 700 square feet. That's the size of a one-bedroom apartment. Who wants an office that small?
This is what you'd call a scarcity play.
Scarcity.
Yeah. Try finding less than 1,000 square feet of Class A office space in a high-income neighborhood. It's nearly impossible. Developers don't build them because the margins are too small. They want to lease out 10,000 square foot blocks. But think about the user.
The source mentions very affluent demographics.
Right. Imagine a private concierge doctor or a high-end therapist, a specialized wealth manager who lives right there in Willow Bend. They don't need a lobby. They don't need a huge conference room.
They just need one nice room to see high net worth clients.
And they want it to be 5 minutes from their house. For that specific user, this space is perfect. And because it basically doesn't exist anywhere else, the value per square foot stays high. Okay, let's shift strategies completely. We've talked about places where people go to work. Now let's talk about mailbox money. The source breaks down some retail and triple net properties.
Ah, yes. The zero landlord responsibility category. This is the dream for the passive investor.
Explain that to me. We've got a listing here in Irving, Texas. A 2,600 square foot retail spot on a 15-year corporate ground lease.
A ground lease is, well, it's the ultimate passive investment. You, the investor, you own the land, the dirt, the tenant, in this case, the corporation. They own the building. They built it with their own money. They maintain it. They insure it.
So if the roof leaks, they don't call you?
If the roof leaks, they fix it. If the building burns to the ground, they rebuild it with their insurance. You literally just collect a check for the use of your ground. It's the closest thing you can get to a bond in real estate.
Wow. That sounds incredibly safe.
Yeah.
What's the catch?
The catch is usually the yield. Because it's so safe and so passive, the returns, the cap rates, are typically a bit lower. You're trading headaches for a slightly smaller percentage return. But looking at this Irving deal, there's another safety layer. Traffic.
49,800 plus vehicles per day.
Nearly 50,000 cars. That's your insurance policy. Even if the current tenant fails, which is unlikely on a corporate lease dirt that sits under 50,000 cars a day, will always have value. Someone else will always want to be there.
And there's a similar vibe with the listing in Aubrey, Texas. A Slim Chickens. The notes highlight a strong franchise operator, 45-plus unit pipeline, and absolute NNN.
Right, so Absolute NNN or triple net is a little different from a ground lease, but for the investor's lifestyle, it's functionally similar. In this
Right.
case, you usually own the building too, but the lease explicitly says the tenant pays for everything.
Everything.
Real estate taxes, building insurance, all the maintenance, the roof, the structure, everything.
So again, you just cash the check. But here,
Yeah.
you're betting on the operator, right? Slim Chickens isn't the government.
Correct. You're underwriting the business. And that's why that note about the 45 plus unit pipeline is so important. A franchisee with 45 units has economies of scale. They have an HR department, a marketing team. They're not just figuring it out as they go. If they're signing a 15-year lease on US 380, they've done their homework, you're essentially piggybacking on their research.
Let's move up the food chain. The heavy hitters. These are the $5 to $10 million plus assets. We have a massive retail center in Mount Pleasant, Texas, grocery anchored by Aldi.
Grocery anchored retail. This is the defensive lineman of a commercial portfolio. It holds the line when things get tough.
Because even in a recession, people have to eat.
People have to eat. But look at the brand specifically. Aldi, they're a discount grocer. So if the economy booms, everyone shops. If the economy tanks, people who used to shop at Whole Foods trade down to Aldi. And the store can perform even better.
So it's countercyclical.
Exactly. And that foot traffic protects all the smaller tenants. If I'm running a dry cleaner or a nail salon, I want to be next to the Aldi because I know thousands of people are walking past my window every week just to buy milk.
The source calls it the dominant retail hub for a 5-county trade area, and it lists a 7.00% cap rate. We throw that term around a lot, cap rate.
Mhm.
For you, the listener who maybe hears it but just kind of nods along, can you give us the real definition?
Sure. The capitalization rate is basically your unlevered yield. So imagine you bought this shopping center for $10 million, all cash, no mortgage. A 7% cap rate means you would pocket $700,000 a year in net income after all the expenses are paid.
It's just a way to compare apples to oranges.
That's it. It measures risk. A treasury bond might pay 4%. A risky startup might promise 20%. A stabilized, grocery-anchored center at 7% tells you the market views this as a solid, moderate risk investment.
Okay, now for the big one. The biggest square footage on the list. A property in Dallas, over 85,000 square feet. Flex Industrial. And the tenant is American Airlines.
This listing uses a phrase that I love, mission critical.
It does sound like a movie title. What does that actually mean in real estate?
It means this building isn't just, overflow storage for extra napkins. Mission critical implies that specific vital operations happen here. Maybe it's avionics repair, maybe it's flight data processing. We don't know the exact function, but the label implies that if this building shuts down, planes don't fly, or a major business unit stops functioning.
Wow. And American Airlines occupies 76% of the building and has been there for 29 years.
29 years. That's a lifetime in corporate real estate.
Yeah.
That tenure proves that stickiness we talked about earlier. The cost for them to replicate this entire infrastructure somewhere else is likely prohibitive. They are entrenched.
So for an investor, that tenure just crushes the risk of vacancy. You're basically buying a bond wrapped in a warehouse.
And you're buying it with a tenant that is, if not too big to fail, at least too big to leave easily.
All right, finally, let's look at the wild cards. These are the listings that don't quite fit the standard mold. They require a bit more vision. First up, we have an off-market deal in Topeka, Kansas, a self-storage facility.
Self-storage is a beautiful business. It's low labor, high margin. You don't have toilets to fix. You don't have carpet to replace. But the killer stat here is no new competing supply within a 5-mile radius.
Is 5 miles really a moat? In a car, that's like 10 minutes.
In the self-storage game, absolutely. Consumer studies show people choose storage based almost entirely on convenience. They will not drive past a facility to save $5 a month. If you own the only facility in a 5-mile circle, you have pricing power. You're a monopoly.
And listing mentions expansion upside with additional land, so that's the value add.
That's it. You buy the cash flow that exists today, but you make your real equity by building more units on the empty grass next to it.
Speaking of land, we have almost 38 acres in Cedar Hill, Texas. But what caught my eye is the seller. It's a THISD asset sale, the Cedar Hill Independent School District, and it's a sealed bid opportunity.
This changes the psychology of the deal completely.
How so?
In a normal negotiation, I offer $1 million. You say 1.2, we meet at 1.1, there's information exchange.
Sure.
In a sealed bid, you get one shot.
Yeah.
You submit your best and final offer in an envelope by a certain date. You have no idea who else is bidding or what they're offering.
That sounds incredibly stressful. You have to sort of game theory the competition.
You do. It forces buyers to be very disciplined. You have to bid what the asset is actually worth to you. If you bid too low, you lose the deal, and you've wasted all your time on due diligence.
But if you bid too high?
You suffer the winner's curse.
Yeah.
You won the property, but you paid way more than anyone else thought it was worth. Sealed bids separate the serious developers from the tire kickers very, very quickly. You have to put your money where your mouth is, blind.
We have covered a massive range here today. I mean, we started with a developer turning apartments back into offices, a total reversal of the trend.
Yeah.
We looked at solid medical offices with new roofs. We saw a mission-critical facility for an airline and a high-stakes sealed bid for a piece of land.
It really shows that the market in 2026 isn't monolithic. You can't just say commercial real estate is good or real estate is bad. You have these pockets of extreme value in industrial, you have defensive plays in grocery, and you have these wild micro trends like office condos emerging from the ashes.
And for you, the listener, the takeaway here is really about knowing what you're looking for. Are you looking for that mailbox money where you never have to visit the property? Then you want that triple net slim chickens or the Irving ground lease.
Exactly. But if you're willing to do the work and take on the risk, maybe you look at that land in Cedar Hill or the storage expansion in Topeka.
Yeah.
But regardless of the asset type, notice the metrics we kept coming back to.
Demographics, household income,
Traffic counts. How many eyeballs are on the property every day?
and tenancy. Who is signing the check, and how hard is it for them to leave?
Those are the three pillars. If you get those three right, rich neighbors, busy roads, and sticky tenants, you're usually going to be okay.
If you want to dive deeper into any of these listings, or just keep a pulse on retail real estate news without doing all the research yourself, Eureka Business Group has a LinkedIn newsletter you can subscribe to. They even have an audio version of their updates, which is pretty handy.
It is a great way to stay informed. The market moves fast, and seeing these bold experiments play out in real time is, I think, the best education you can get.
Before we go, I want to leave you with one final thought to chew on. We started with that office conversion. If developers in 2026 are confident enough to turn apartments back into offices, are we seeing the pendulum finally swing back? Is the remote work forever narrative officially dead?
It could be the start of the great reofficing, potentially. The market usually moves with the money. If the smart money is betting on people returning to desks, the people usually follow.
Something to think about the next time you see a construction crane and assume it's another apartment complex. It might just be your new office. Thanks for listening, and we'll catch you on the next deep dive.
But goodbye, everyone.